Welcome to the latest episode of our podcast series for financial advisors. Today's episode is 2025 Mid-Year Report on Deals, Transitions, and Recruiting. It's a special industry update with Louis Diamond. I'm Jason Diamond, and this is the Diamond Podcast for financial advisors.
At Diamond Consultants, we help elite advisors identify the right environment for their businesses to thrive, whether that's at a wirehouse, boutique, or independent firm. With nearly 3 decades of experience, we've guided thousands of advisors and represented more than $250 billion in assets transitioned. And each year, 1 in 4 advisors managing $1 billion or more who change firms are our clients. Our process is education-driven and based on building relationships, starting as your strategic partner well before you're even thinking of a move. To schedule a confidential conversation, call us at 908-879-1002. Wondering why advisors change firms and where they're headed? Are transition deals going up or down? Those very questions and more inspired us to create our annual Advisor Transition Report. It's the award-winning, data-driven resource designed for advisors that connects the dots between the motivations around movement and the firm's appetite for top talent. Arm yourself with the knowledge you need to make smart decisions. Download your copy at diamond-consultants.com/transition report.
If you're an advisor wondering what the second half of 2025 might hold, the first 6 months already tell a compelling story. From headline-making transitions to evolving deal structures, the pace of movement so far suggests 2025 is shaping up to be one of the most competitive years yet. That's why we're releasing this special mid-year update, our data-driven look at the recruiting landscape right now. In this episode, we'll dig into what the numbers are showing, particularly at the wirehouses, then highlight some of the most notable moves to date, and share perspective on how deals are shaping up across the industry. We'll also revisit the predictions we made earlier this year, what's proven accurate so far, and what remains unresolved. And we'll look forward to the second half of 2025. Will the momentum continue? What external forces could trigger a shift in activity? And how might firms adjust their recruiting strategies and deal structures in response? There's plenty to cover and insights you won't want to miss. So let's get to it. Louis, as always, thanks for jumping on here with me.
Yeah, of course. This is a fun topic, so I'm excited to talk about it.
I think of this episode as a little bit of our companion for our series of transition reports we've started doing. And Louis, maybe you were sort of the mastermind behind the original idea with those reports. Tell me why we started doing the transition reports and maybe just briefly touch on, for those who aren't familiar, what the reports cover.
Absolutely. So over the years, I've become big fans of some of the M&A reports that investment bankers and firms like Fidelity put out. And I recognized that there wasn't really a comprehensive and succinct data source for financial advisor transitions. So obviously we're recruiters and it's good for us when people make changes. But the real purpose of it was because we believe that advisors can learn a lot about where their peers are going, who's joining their firm, and just overall movement trends in general. So it was just really an attempt to understand that. And we've been very pleased with the reception and now have decided to segment it by certain firms as well. And you've really taken the ball on building this out and adding a lot of the pros around the raw data.
Yeah, absolutely. This is timely because we're in the midst of releasing those, what we call micro reports as we speak. We'll link to the individual reports on this podcast page. But for now, we're going to treat this episode as a standalone episode. So no need to be familiar with the reports or having read the reports to listen to this episode. Let's dive in. I view this as like our mid-year State of the Union or state of recruiting, if you will. So let's start with deals because that's what everybody seems to ask us about most. Can you talk first about W2 World? Give me a little bit of a high level on what you view as deal update in the traditional recruiting space.
Yep. Yeah. So I think every year people worry like, are deals at an all-time high? Are they going to pull back with interest rates going lower and turbulence in the markets and tariffs, et cetera, et cetera? But that really hasn't had any sort of impact. If anything, we've seen firms become slightly more competitive for larger and more sophisticated teams. I think a big reason is supply and demand. There's only a certain number of advisors who transition in a given year, and there's more firms to try to capture that advisor flow than ever before. And if one firm or multiple firms have really stepped up their competitiveness, other firms have to follow. It's part of it's keeping up with the Joneses. Like in the past, it was one wirehouse would make a big change. Let's say UBS, Morgan Stanley, Merrill, Wells Fargo would follow. We still see that to an extent, but now there's probably 25 other dominoes that fall when one firm has a big move. So it's definitely a good time to be in an advisor's shoes, either because the markets are doing good, businesses are growing, but also for those inclined to make a transition. It's not just that recruiting deals are bigger, the structures are better for advisors, but also valuations for practices. If someone is independent and wants to sell, or someone is an employee and wants to sell to a private equity backed RIA, or go out on their own and build for long-term enterprise value, all the factors on the financial side are really aligning for advisors these days.
Yeah, I agree with that. I think as I think specifically about employee firms, I want to talk more on your comments about independent firm valuations in a bit. But starting with employee firms, in my opinion, there are two main kind of trends or maybe themes that I would say defined the beginning of the year. And I'm curious for your take on this. But in my opinion, number one, Merrill. I think you have to mention Merrill being back in the recruiting game. And that's actually the first of the firm-specific reports we're going to put out. And worth noting, so Merrill still suffers competitive attrition, just like all of their other wirehouse peers. They lost, by our count, 255 experienced advisors in the first half of 2025. That is better than the previous year. That's about 100 less advisors than they lost the previous year. But what we're looking more at is the other side of the ledger. Are they able to recruit competitively again? And that the data is starting to tell a more rosy story. And obviously that ties hand in hand with the idea that Merrill is once again recruiting competitively, paying, in my opinion, one of, if not the single top deal on the street. So that'd be my first theme. My second would be the regionals. I don't love the term regionals, but maybe super regional is perhaps a better name. What I'm really referring to here is firms like RBC and Raymond James. To me, these firms being firmly in the lane of wirehouse firms is the other major story of the year. Like a UBS advisor is just as likely in my mind to consider RBC as they are Morgan Stanley. What are your thoughts?
Yeah, and I completely agree. Yeah, and it's interesting with a firm like Merrill. I mean, there's only 4 major wirehouses. So if you have one of the major players is back in the market and really trying to claw its way back with, I agree with you, probably the top deal across the industry, other firms have to take notice, not just their wirehouse peers, but also any other firm that wants to recruit the types of advisors that Merrill's going for. So it is a big deal. It just drives the market a little bit higher, or at least keeps things where they are. And yeah, I would agree with you on the regionals or the super regionals, where the deals for those firms are either at parity with the wires or close. And we've even seen like firms like Raymond James and Stifel that historically were, we'll say, like below the market on deals, or kind of they weren't setting the market on fire, really step up for larger teams. And the same dynamic is we know we have to pay up to get the best possible talent. And if we don't, even though people might love us and it's a great culture, we're not going to win as many deals. We're also not going to get as many looks to get people into the pipeline.
Yeah, I think that's right. I want to ask you one more question on Merrill, and then we can transition into the more independent side of the ledger. If you are an existing Merrill advisor, so an advisor who's been at Merrill their whole career, or maybe the last 10 years, whatever the case may be, why should you care that Merrill is back in the recruiting game? Does it matter? Or maybe you shouldn't care. I think you should.
Yeah, I think you should too. I mean, it's probably two sides of the coin, a positive and a negative about why you should care. The negative is, oh, the firm's paying this much to recruit advisors that are smaller than me or aren't as quality as me, and they're not investing that money into me or my team, or I think I should get a retention deal, or I think they should increase CTP, which is their retirement plan. So there's that side of it. But I think that's always the dynamic. Like these firms are always paying big dollars to recruit people. And if a Merrill advisor is so inclined, they can take advantage of the same dynamic if they wanted to make a transition. I think on the positive side, it does two things. The first one is they're restocking the pond with growth-minded, sophisticated advisors. As advisors leave through attrition, they retire, they get fired, they leave the industry, the firm gets smaller. And what's been happening is trainees have been added, bank-based advisors, and they don't necessarily carry the same cultural dynamics as a top producer or even a mid-range producer from a competitor. So I think it's good just from developing the culture and the like. And then I think the last thing it does is it just puts Merrill more firmly in a positive way back on the map. Like with peers, being in the media in a positive way, as firms get more recruiting momentum, they just kind of have like some sunshine shining over them. And I think that benefits advisors and their excitement or their perception of their current firm.
I actually hadn't thought about as much about that last point. Like I'd thought about the concept of advisor morale and that it was probably a little bit draining to be a Merrill advisor, seeing all these corner office guys do nothing but leave all the time. But I think there's like a media PR piece of this too, which is it felt like just a deluge of negative headlines about Merrill, only negative for the last however many years. And that feels very much like it's shifted, and honestly, probably shifted at the expense of UBS. We'll talk a little bit more about UBS. While we're on the topic of deals, I want to pivot to the independent space because we have ample independent advisors who listen or advisors who are considering independence. Headline, just let's not bury the lead. In my opinion, deals in the indie space have crept up probably closer. When I say indie, I'm talking now about independent broker dealers. Probably crept up closer to 100% of revenue or GDC. You agree with that?
Yeah, I think they've even not even crept up. They've jumped up even more significantly. You can pinpoint like pretty much the exact day that this dynamic happened. LPL Financial acquired Commonwealth Financial Network. I think it was in March or April. And as that happened, probably a week after the deal was announced, we saw Raymond James, the independent contractor division, their broker-dealer side, really increase their deal specifically to attract Commonwealth advisors. In some cases, there was almost a 50% increase in the deals they were paying just a week or so before. So then, like we said before, keeping up with the Joneses, we saw 4 or 5 other firms follow the same strategy, saying, hey, these are great advisors. We're kind of at a moment in time here where we think we can win. And if we want to win, we have to keep up with our competitor. So it's going to be really interesting is these independent deals are absolutely crazy. Some would argue, and I probably agree, a bit unsustainable based upon the high payouts and how much the broker dealers make and how much they're paying in a recruiting deal. But at least for right now, we're seeing these deals stick around for non-Commonwealth advisors. I haven't heard of them going down. There's a chance, but I do think it's one of those things where if you think you have a move in, you want to move within the independent space, this is definitely the time to strike while the iron's hot, because I would be surprised if these deals stick around forever. I don't think there's any room for them to go up. So if you're inclined to be in that segment or move within that segment, you can draft off of the Commonwealth news and have it benefit yourself.
So fair, and I agree with everything you said, but that's to me only half, if that, of the independent space or of the independent story. We speak with a lot of advisors who are either at an independent broker dealer and are ready for their next step, or wirehouse advisors or captive advisors who want to break away, but they don't want another captive custody model, another model where you're sort of beholden to a single chassis. Let's talk about the RIA space and the RIA platform space. Deals in that space, is it just if you want to move more towards the RIA space, you forego all transition capital?
I would say in large part, yes. If you go and start your own, then you're not getting any upfront capital aside from the couple basis points that a custodian provides as benefit dollars or soft dollars to help start the business, but it's not really a deal. There's a handful, not a ton. We call them RIA platforms, basically RIAs or hybrid RIAs that advisors can affiliate with, still own their business, but get some extra scaffolding and support. And a handful of these firms do provide forgivable loans. We have seen them in some cases increase, but that's not really the driving factor for people moving in that direction. The other newish dynamic that's picking up steam is the concept of selling a minority stake in your business, either at time of launch or in the future. If you look at a firm like Elevation Point, which Jim Dixon, who founded Sanctuary, founded not that long ago, they're having some pretty decent early success in this model. Firms like Merchant are buying minority stakes. There's practices affiliated with broker dealers like Wells Fargo that are doing the same thing. So there's a multitude of different ways that an independent-minded advisor or wannabe entrepreneur can look at monetizing their business. There's forgivable loans, which we talked about. There's minority investments. There's certainly debt solutions out there. And we've even seen a number of wirehouse teams sell their entire business to a large RIA firm at capital gain. So it's kind of like choose your own adventure. There's obviously pros and cons of the different forms of capital. But I think there is a way, like if you want to be independent and you have a bunch of deferred comp, or you owe back money on a note, or you have to pay back a deal for a retiring advisor, or expensive in your mind to start an independent business. It's not like you have to bootstrap it. Sometimes bootstrapping is the best long-term decision because you keep all options open, you're not tied to anything, and you can really control your own destiny. But the point is ample opportunities to monetize, just a matter of what's most important to you and what you're willing to give up in order to accomplish it.
To me, I think what we've created a little bit is this dynamic where an advisor can pick the model or the firm or the framework or the type of business based on the merits of that model. The reality is the capital, not in all cases, but usually there are ways to figure out the capital. So I guess what I'm trying to say is if your ultimate goal is, I really want to be an RIA, it's not that common that you'll hear an advisor say, I really want to be an RIA, but sometimes you do hear, but I need the transition capital. But I think what you're alluding to is the fact that, fine, if you need the transition capital, there might just be ways to have your cake and eat it too, right? You might be able to achieve the model you want and get the capital either via an equity sale, a debt solution, right? Go to a bank. There's banks that lend specifically into this space. We went kind of backwards. We started with the deal because I know that's what our audience asks us about most. So intentionally started with the dollars. I want to move on now to just winners and losers, if you will, or just, we mentioned Merrill here. I think we have to talk about UBS. What's your take? What's next for UBS?
Yeah, I mean, we've done like rapid reaction podcasts about their compensation plan change at the end of 2024. And there's a lot of headlines about this. My take right now is UBS is between a rock and a hard place. Like people are still relatively happy there. It's a great brand, great platform. They have I think they still have the highest average production per advisor in the industry. They are the kind of high-end boutique firm within the wirehouse segment. So there's a lot to like about UBS. But the flip side is they've been very direct, their new leadership, in saying, we need to really boost our profit margin, which is about half of what Morgan Stanley's is and decently off of what Bank of America Merrill is as well. And the truth is there's only really three ways to boost a profit margin. It's to cut costs, which they've been doing with their compensation plan change, like changing ratios for support staff, hiring freezes, getting rid of some subject matter experts at the home office level, consolidating markets, et cetera. But the more you do that, the more you lose advisors. This year alone, and basically as of August of this year, UBS has lost almost double the amount of assets this year so far, so say 7 months in, as they did in all of 2024. And it seems like every day or two, there's a new billion-dollar plus team on the move. Just looking at our business, I think there's going to be a lot more attrition coming up. So it's a challenge because the one way to boost the profit margin is to cut costs, but that's proving that they're going to lose advisors, which means their scale goes down, which means their profit margin goes down. The other way to close the gap on profit margin is to grow. Every advisor wants to grow. UBS advisors grow, but it's not like you can sprinkle magic fairy dust on an advisor's business and expect it to grow an extra 10% each year. So the third way you increase profit margin is to do a big acquisition. So maybe there's some targets out there. It's hard to say if there's anyone big enough and meaningful enough that's really going to add that scale after an integration is complete. And at the same time, acquiring someone or something that isn't going to marginalize or anger the current advisor force. Let's say they bought, I don't want to pick on anyone, but a firm that had 2,000 advisors that had a kind of down market reputation. All that would do is it would make advisors who view UBS as this high-end, ultra-exclusive club say, hey, like they're kind of cheapening the brand. So I don't know what's going to happen. I mean, I think there's a better chance than we ever thought that the Swiss are going to spin it off to private equity, kind of like Penn Mutual did with Janney, selling it to KKR. Maybe there's a full sale. Maybe they just decide, hey, like the strategy isn't working. Let's kind of forget about the profit margin for now. Let's just kind of normalize, and we'll figure out kind of a different way to achieve these goals. So it's just an interesting dynamic because it's like a snowball rolling down the hill. As more advisors leave, the snowball picks up size, picks up pace and velocity. Then it gets to a point where basically you've reached terminal velocity and there's no more snow left on the hill because the snowball's picked up every last snowflake. Like I feel like we're not there yet, but like as more of these big teams leave, we're kind of getting closer and closer to that dynamic.
Yeah. So a couple of things I'd say there. First of all, the momentum factor is very real. I got a reporter asked me, I think it was last week, like, so, okay, they changed their compensation plan. You're telling me it's led to this much attrition? I think what it did is it almost gave advisors permission. Like they saw, oh my God, my colleagues are leaving. You start to notice all those little minor annoyances. They become more major annoyances. And more importantly, I think there's a perception among UBS advisors that the majority of wealth management leadership is sort of taking the approach of like, we know we're upsetting all of our advisors and we know we're going to lose a lot of our advisors and we just don't really care. And the one comment I make about that in defense of that is, I'm not saying I agree with that strategy. I'm not saying it's the right strategy, but it is a strategy. Like, we get the comment a lot from advisors like UBS is morons and they don't know what they're doing. I don't think that's the case, right? I think they are comfortable in this strategy. Ultimately, to your point, it may backfire because I think the teams they're losing are bigger than they expected. I think they were hoping to lose the more marginal teams around the edges that weren't as profitable, that were getting paid less, less generating new business for the firm. So agree with your take. And I certainly think this is probably the fourth inning of this story, if you will. I don't know which direction we had. I think you laid out the likely pass. I'd maybe posit one more, which is like just a wholesale, like almost what I view as what Merrill did, right? A wholesale change in wealth management leadership. And then they just completely pivot on this strategy. We've seen that, right? It's not like firms are married to strategies forever. So very fair. What about advisors? So you're a wirehouse advisor. I think that begs the question. Let's just say hypothetical wirehouse advisor. I know I could go independent, but that's a bridge too far for me. Who are the winners then as you view it?
Yeah, so I mean, it's certainly the other wirehouses, like still, regardless of the perception that every wirehouse advisor is breaking away for independence, like it's overblown. Like, we have the data to support it. The wirehouses still capture not the majority, but I would say the largest proportion of advisor moves happen within channel. So wirehouse to wirehouse. So it's Morgan Stanley, Merrill, and Wells Fargo are certainly doing well on the recruiting side. But then you said earlier, like the super regionals, the regionals, like Raymond James, RBC, and Stifel. Like Stifel, they didn't have a great recruiting year in 2024, but they're killing it so far in 2025. Raymond James has kind of the last 10, 15 years has kind of always been the belle of the ball in recruiting. But what I'm seeing is really ratcheting up their wins and their big wins. RBC is the same. I mean, RBC has probably won the most UBS advisors so far, and seems like the model is resonating with advisors. And then you have to mention firms like LPL, which on their W2 Linsco channel is picking up a lot of momentum. They're winning across the board like they always do. And then certainly many firms on the independent side. Dynasty's had a couple of large wins. Sanctuary's had a bunch. This firm Elevation Point is really finding their stride. We're seeing some big RIAs win. So it's like, it's hard to say like one winner. I think depending upon the segment or the channel that someone's in, like you can kind of pick like a top one or two. And a firm I forgot to mention was Rockefeller. They're kind of always doing their thing. They're kind of almost in a category of their own. Like when we look at the data, like they don't win. It's not like they have like 20% of advisors go to Rockefeller, but they'll win like some of the larger moves in the industry. And they don't need to recruit hundreds of advisors. Like if they win 4 or 5, like $10 million and up teams, like that fits their strategy better. So there's a lot of winners, a lot of losers, but I would say there's more winners than losers, but the losers are kind of losing at a higher rate than they ever have.
I agree with that synopsis 100%. I'm curious your take on this idea that if I'm a big team, I have to look at the independent space. Do you see that with advisors?
Honestly, people we work with, unless they like immediately say, nah, independence is not for me. Like I get it. I have friends that went there, or if I was 15 years younger, I would consider it. We still encourage advisors, even if it's like a 1% chance, to at least take some time to understand independence, because obviously there's a lot of movement there. Oftentimes it's the solve or the anecdote for most frustrations an advisor has. Like usually advisor frustrations are around control and flexibility and freedom and autonomy, and independence is the best possible solve. Doesn't mean it's for everyone and you're giving up a decent amount of upfront capital or work-life balance or taking a bigger risk than you would otherwise, but it is the solve. So we always encourage folks to at least understand it, and certainly for a bigger team to understand the valuation dynamics, because with larger practices, the valuations for an independent firm, they scale exponentially. Like recruiting deals, they get a little bit better and more attractive if you're a bigger team, but they kind of cap out. With independent M&A, I mean, I've seen deals that are 6, 7, 8 times revenue when it's all said and done for a team that's looking to sell. Some could even be higher. And usually firms are valued on a multiple of EBITDA. So if the firm has a lot of payroll and overhead, et cetera, it might be lower. But the point is, if you're a very large team, and even say a mid-sized team, you're almost always going to be better off over a 3 to 5 year period financially to look at higher payout of independence, perhaps a recruiting deal, but most importantly, the immense value that you're creating that has a lot of room to run right now.
So that's a good segue then into the independent space in terms of winners and losers. Look, I think we have to start this conversation with LPL because they have become 800-pound gorilla is probably not a heavy enough gorilla at this point. And that's not a sales pitch. It's just the reality of the percentage of the market share in that space they control. But at the same time, like we do the raw analysis, and there are literally hundreds of firms that win advisors. So is it a myth or a fact that LPL is just gobbling up the competition or somewhere in the middle?
I think it's a fact. I mean, they acquired probably their toughest competitor in Commonwealth. They acquired Atria Wealth Solutions last year, Waddell & Reed before that. So they're absolutely on the acquisition train, but they're also probably one of the most prolific, if not the most prolific recruiter in the industry, like with multiple channels and kind of ways for them to win. They're kind of always in the game right now. So it's not that everyone goes there. They're certainly not the right fit for everyone, but they're, I think, doing a very good job of kind of using their scale to bully the competition to an extent and really just invest back in the firm in ways that advisors care about. So new affiliation models, new resources, new transition resources, cutting the expenses that advisors pay, et cetera.
Yeah, it's one of those instances when, to me, advisors who poke holes in LPL are often doing so because for some advisors, just the idea of working for the 800-pound gorilla isn't appealing, right? Like there's always going to be those advisors who just prefer the boutiquier feel. We recently spoke with the CEO of Cetera on our podcast, and one of his comments was around big but small, right? You need to have the scale in order to compete with the LPLs of the world. But how can you make this firm feel smaller, more nimble, and more sort of culturally attractive than in some of the other massive firms on the space? Agreed?
Totally agree.
Let's switch gears now. The last two segments of our show today will be predictions, and then we'll run through some representative deals at the end. Predictions, let's take two different kind of looks at this. One is, let's talk a little bit about some of our predictions that we made earlier, but also what do we expect to see going forward? We spoke a lot in the earlier transition report we did when we published predictions about retire-in-place deals, about how retire-in-place deals, CTP, Alpha, FAP, Heritage, they are going to become the de facto retention tools that a lot of firms use. Do you think we got this right? Do you think this is going to get worse? Tell me about retire-in-place and the impact.
I completely agree. I mean, it wasn't rocket science. That one wasn't too much of a stretch because that dynamic's kind of been at play for a while. Yeah, the firms, there's no incentive to make the retirement deals worse because ultimately the inheriting team ends up pretty much paying the whole deal, even if the firm is kind of the bank or the underwriter on it. And it does retain a retiring advisor really into perpetuity, and their inheriting team anywhere from 5 to 8 years, depending upon the structure and depending upon the deal. So like when advisors are like, hey, like I think XYZ firm's going to pay retention, our answer is always like, maybe, that'd be pretty awesome, but they don't need to because all they have to do is kind of turn the dial on the retirement deal, increase it 20, 30%, whatever it is, and you'll have more advisors sign on and then their team members also signing on, which has the same impact to retention as paying every advisor or some advisors a blanket retention deal. So this is only going to continue. I mean, more advisors are retiring, more advisors are coming into the industry wanting to take over books of business. And it seems like the new trend is if you're an up and coming advisor, it's kind of hitch your wagon to a big team. Like you still have to demonstrate yourself and grow. And ultimately you got to be the master of your own destiny. But we're seeing a lot of like young hotshot advisors with big books, but they have big books because they took over the business of someone who retired. Like, hey, there's many ways to skin a cat. It's not like there's anything wrong with that. It's just a different way to do it. So yeah, I think this dynamic's going to accelerate more with firms being more aggressive on the retirement deals, especially if I think one of our predictions was about private equity owned RIAs really making a dent in wirehouse recruiting. I think we've still been a little bit early on this trend. I think it will happen. The pitch is basically, we can acquire your business, but by doing so, we can buy it at long-term capital gains. Because we're acquiring it, we're willing to pay more than a typical retirement deal. You can get some equity. So I think if those types of deals begin to pick up steam, and obviously no advisor wants to pay ordinary income when they can pay capital gains, that could also put these firms kind of on notice to change their structure in some capacity if they're able to, or just to make them more competitive.
It's a brilliant point you make because, and I remind firms of this a lot, to me, the new landscape, one of the interesting things about it is, and I say new meaning the idea that the industry landscape is not just wirehouses and RIAs. There's all these legitimate options. One of the interesting things about it is you are no longer competing against just your peer set. So you talked about the dominoes falling when somebody changes deals. Morgan Stanley is no longer just competing against Merrill and UBS and Wells Fargo, because the reality is a wirehouse team knows they can move to RBC or Raymond James. They can move to a boutique firm like Rock, right? So they know they have all, and private equity, and they have all of these distinct paths that they can walk now, which means that when a firm sort of takes stock of the competitive landscape, the good ones, in our opinion, know that, and they structure deals that reflect that reality. Retire in place deals included in that. I'm going to take the next one, winners and losers. Again, not rocket science, but I think we talked about how the winners and losers were bifurcated. A lot of firms lost many advisors and a lot of firms gained many advisors. I think that will continue to be the case into 2026 and the end of this year. I'm going to give a caveat, which is I do feel that the pendulum has shifted a little bit back towards the traditional space. So if the breakaway wave was full steam ahead, max pedal to the metal 3 to 5 years ago, I think the wirehouse firms, I think, were kind of written off as like, oh my God, every advisor is going to go independent. And I guess what I'm trying to get at is we don't see that playing out. There are still ample advisors that prefer the big brands and the stability. Do you agree with that? Or do you think I'm off base and we're going to start to see kind of a re-acceleration of movement into the independent space, the breakaway?
No, I completely agree. I do think, though, that we'll see some like very large and even like monumental breakaway deals happen this year and next year, largely because of the dynamics I was talking about around valuations and the way that large enterprise building advisors are valued. So yeah, I think from like an advisor headcount, like percentage of move standpoint, you're completely right. But I think there's going to be some massive breakaway deals that we'll see coming up. Maybe I have a little bit of inside knowledge on that, maybe not, but just kind of reading the tea leaves and talking to advisors. So but I think it's great because there isn't like one clear path. I mean, it's extra complexity, extra things to understand and grapple with and basically just assess trade-offs. It's not so easy as it was to settle on or pick your ideal firm. But I think it's a very good thing for advisors because there's legitimately like 20, 25 different firms that, and even more than that have a legitimate shot of winning. Like even if you look at a firm like And Partners, which wasn't even a thing like a year or two ago, like they're already over 30 billion in assets. And it's just a completely different type of firm than we've seen before, where it's really all about the equity and buying into that story. So like, I'm excited to see kind of what's ahead, like what other new firm is going to come out and kind of have a new model that really starts to catch fire with advisors.
I agree with your point about teams. There's an economic component to this in my mind, which is that for smaller to medium teams, so let's say even big teams, like let's say sub 5 million, the math between the forgivable loan plus a retire in place deal versus maybe modest recruiting deal in the independent space coupled with the ability to sell, that delta is not huge. I mean, we have advisors do this analysis all the time, where when you compare the two, there may be a difference, but it's not, oh my God, this is a no-brainer. But when teams get huge, 15, 20 million in revenue, and we've done several of these deals now in the past couple of years here, that's when the delta is sometimes too big to ignore, where you could take the ordinary income traditional recruiting deal plus the ordinary income retire in place deal. But when you compare that with what you'd be able to sell the business for at cap gains, because of how high the multiples are for those mega businesses, the chasm is huge.
I'll give you a live example. So I'm representing, it's probably close to a $30 million wirehouse team. I won't give any more distinguishing information. We did a pro forma analysis for that advisor and just kind of a hypothetical back of the envelope valuation. That business with fairly modest growth over the next 3 years has a fairly easy path to be worth almost $250 million. I'll repeat, over $250 million. So that's an insane multiple. I mean, this is like an incredible advisor who grows, who's just an absolute killer. So it's not like everyone's going to get that. But when you have that dynamic where it's like, I mean, he basically laughed at me when I told him what recruiting deals were. He's like, why would I do that? So like, not for everyone, that's not always the dynamic. But if you're a large growing team or you have aspirations to be an acquirer and to recruit advisors, like you have a pathway to build generational wealth in selling of the business if you kind of make the right decisions along the way.
No doubt. I love ending the predictions there with let's talk $250 million. You got to end with the eye-popping stats. So let's pivot now. Representative deals. We don't have to go into too much detail here, but I want to talk just high level. We can rapid fire kind of back and forth. Let's go through some of what we view as the biggest not necessarily the biggest, I should say, deals that were representative of an interesting trend that we saw from the first half of the year. So I'll take the first one. We saw Kruger Fostick and Associates launch an independent business with New Edge Advisors in Florida. And this team was previously with Merrill. I wanted to talk about this deal because New Edge Advisors represents what you were alluding to, a supportive independence platform that allows advisors to effectively run their own independent business, but with an additional element of scaffolding and support. So for the advisor who says, I want to be independent, launching my own RIA sounds somewhat appealing, but it's probably a bridge too far because I don't want to have to pick out the K-cups and put the toner in the copy machine. This is a great kind of middle ground. And New Edge is also an example of one of those platform firms that pays certainly not a lucrative recruiting deal, but they offer something in the way of transition deal. So the advisor probably monetized to a small degree.
You look at a firm like New Edge, they have also a ultra high net worth segment that is an example of a acquirer of wirehouse teams. They also can be a buyer of an advisor's business on their platform in the future. So like they kind of play in different forms, and I think are symbolic of a big trend across the industry. Okay, I'll take the next one. It's Peter Borowski and his team joined Merrill from UBS in New York. About $1 billion in AUM. End of April was the move. So we didn't represent this deal, but it's telling because it's an example of a very large team that went wirehouse to wirehouse. Even though they could have gone to a number of different places, they decided that in this case, Merrill was the best fit. And also, I think also shows that Merrill is back in the game of competitive recruiting. So kind of telling of what we were saying before, wirehouse is still a very viable destination for large wirehouse teams, but also seeing Merrill come back in is illustrative of a larger trend.
Yeah, that one was important to me because important in the sense, like there's nothing in and of itself, I think that's groundbreaking about it, but I think it's a really important data point to Merrill to say, look, we went to market with the big boys. We competed for a corner office UBS wirehouse team, which I think most people who recruit would agree, corner office wirehouse teams are the gold standard in our business, and they won the business. So to me, like that's proof of concept 101. All right, let's wrap now with one more, which to me is probably the most kind of down the fairway type of transaction we saw in the beginning of 2025, which is Austin and Smith, two advisors with UBS, moved to RBC in New York. This to me, again, down the fairway in the sense that the business was around $500 million. So I think kind of right in that sweet spot, kind of standard wirehouse, good quality, really nice sized business, but also a team that would have had the world is your oyster type of options. We did not represent them, but just knowing this type of team, they could have spoken to any independent firm, any boutique firm, certainly any wirehouse, and ultimately settled on RBC, opted for RBC because they felt it combined kind of the best of all worlds, the culture, the freedom, but you still need to have a full service platform, technology, and investment solutions to be able to service teams like that. Anything else you want to touch on, Lou, before we close? This has been fantastic. I think we got a really good flavor for what recruiting looked like in the first half of the year and hopefully set the stage nicely for the second half of the year as well.
Definitely. I'll turn the mic around and ask you a question. I can weigh in afterwards. Based upon what we've seen so far in the first half of 2025, what do you think the full year is going to look like? Like, do you think overall advisor movement is going to be high? It's going to be low? It's going to be about average?
Oh, it's a super interesting question because when we do these reports, we use headcount, and we use headcount because it's the best we have, meaning we just literally look at advisors who have been in production for 3 years or more. Did they move firms? Yes or no? If yes, we count them. I would be much more interested in seeing quality and size of advisor. So I guess from a headcount perspective, I would expect to see movement flat to slightly up. But I think what I know to be true when we look under the hood is that the quality and size of teams in motion between the UBS story and the Commonwealth story is unlike anything we've seen, in my opinion.
Yeah, I completely agree. It's the headcount wise, advisors moving in a given year, like probably about what it normally is. It's usually like 5-6% of all advisors change firms in a given year. I think we're kind of tracking to that. But yeah, there's been many more billion-dollar plus teams on the move. And I completely agree with you. If you look at the average age per move, which we don't have the luxury of having that type of granular data, it's certainly going to be probably the highest we've ever seen. And I expect that trend will continue given the dynamics at UBS and otherwise.
Excellent. Well, it's good to end on a nice note of agreement in early January, and we'll do the full year recap, but this was fantastic. Thanks again, Lou.
Anytime.
As a financial advisor, you hold yourself to the highest standards of integrity, honesty, and credibility. You are successful because you take your professional responsibilities seriously and are dedicated to your clients. But are you living your best business life? Are your goals aligned with your firm's, or could a better option exist? Should I Stay or Should I Go is a book written with you in mind. It's a self-guided journey that walks you through the key steps that we take with our advisor clients. This strategic thought process and roadmap to professional self-discovery is designed to help you ask the right questions and think critically and objectively, whether you're considering change or not. Learn how to get your copy at diamond-consultants.com/thebook.